Audit risk is the possibility that the auditors may unknowingly fail to appropriately modify their opinion on financial statements that are materially misstated. In other words, this is the risk that the auditors will issue an unqualified opinion on financial statements that contain a material departure from GAAP. Auditors must obtain sufficient appropriate evidence to reduce audit risk to a low level in every audit. Management makes implicit and explicit assertions about the components of the financial statements in the account balances, classes of transactions, and presentation and disclosure. Here are the assertions for the three components. Existence or occurrence. Assets, liabilities, and equity interest exist and recorded transactions have occurred. Rights and obligations. The company holds rights to the assets, and liabilities are the obligations of the company. Completeness. All assets, liabilities, equity, and transactions that should have been recorded have been recorded. Cutoff. Transactions and events have been recorded in the correct accounting period. Valuation, allocation, and accuracy. All transactions, assets, liabilities, and equity are included in the financial statements at proper amounts. And presentation and disclosure. Accounts are described and classified in accordance with generally accepted accounting principles, and financial statement disclosures are complete, appropriate, and clearly expressed. Inherent risk is the risk of a material misstatement occurring in an assertion assuming no related internal controls. Control risk is the risk that a material misstatement in an assertion will not be prevented or detected on a timely basis by the company's internal control. And detection risk is the risk that the auditor's procedures will lead them to conclude that a material misstatement does not exist in an assertion when in fact such misstatement does exist. Inherent risk and control risk are the responsibility of management. They control those two risks. But detection risk is the responsibility of the auditor. The auditor controls detection risk. The auditor must obtain sufficient appropriate evidence. I highlight the word appropriate. To be appropriate, audit evidence must be relevant and reliable, must be both. Let's go through several things that makes evidence reliable. Audit evidence is ordinarily more reliable when it is obtained from independent sources outside the company, generated internally through a system of effective internal control, obtained directly by the auditor, documentary in form rather than oral, and provided by original documents rather than copies. Let's go through some steps in the audit process. Risk assessment procedures are done to obtain an understanding of the client and its environment, including its internal control, to assess the risk of material misstatement. The test of controls are, when appropriate, they test the operating effectiveness of controls in preventing material misstatement. The substantive procedures are used to detect material misstatements at the relevant assertion level. Substantive procedures include analytical procedures and test of details of account balances, transactions, and disclosures. Substantive procedures are those audit procedures that substantiate an account balance. There are two types: analytical procedures and the test of details. The test of details may be test of account balances, test of classes of transactions, and test of disclosures. The auditor may change the degree of detection risk by changing the nature, that's the type and form, the timing when performed, and the extent, the quantity of evidence obtained of the audit procedures. To reduce detection risk, the auditor may obtain more reliable evidence that relates to the nature of the audit, or change the quantity of evidence, test more items that relates to the extent of the audit, or wait until year end to obtain evidence from an entire set of transactions as contrasted to performing interim testing, say 2 months prior to the year end, and then simply updating those procedures. That relates to the timing of the audit procedures. And remember, the auditor is the one who controls all three of these components. Analytical procedures are done in the audit planning phase, required, as a substantive procedure may be used, and during the final review, required. Types of analytical reviews include a trend analysis, analyze changes in accounts of a company over time; ratio analysis, compare relationships between two or more financial statement accounts or comparisons of account balances to non-financial data; compare budget to actual and current year to prior year balances; profitability, such as the gross profit percentage; and activity, such as inventory turnover. The basic approaches to auditing accounting estimates are: 1. Review and test management's process for developing the estimate. 2. Independently develop an estimate to compare to management's estimate. And 3. Review subsequent events or transactions bearing on the estimate. Related parties are those that can significantly influence the actions of the entity being audited. Examples include officers, directors, principal owners, and members of their immediate families, and affiliated companies and subsidiaries. Even if the transactions with related parties are properly recorded, they must be adequately disclosed in the financial statements. A primary challenge the auditor has is identifying undisclosed related party transactions. Audit documentation should be sufficient to enable an experienced auditor to understand the work performed and the significant conclusions reached, identify who performed and reviewed the work, and show that the accounting agree or disagree to the financial statements. Audit documentation should include all significant audit findings and the actions taken to address them. The primary function of the audit work papers is to support the auditor's compliance with auditing standards and support the auditor's opinion. Secondary functions include aiding the audit team members in planning and performing the audit, assisting in supervision and review of the audit, and demonstrating the accountability of team members and assist internal reviewers, external peer reviewers, PCAOB inspectors and successor auditors in performing their various roles.